Welcome to the Lucia Capital Group Weekly video. If you've been following these videos for any length of time, you're probably aware that I don't much care for rules of thumb regarding investing or financial planning. Generic advice is almost never better than individualized planning because every unique situation requires a unique strategy. But if I had to pick one rule that's as close to ironclad as you're likely to find, it is this one. Risk and reward almost always tend to go hand in hand. You can't expect higher returns without accepting higher risk, nor can you expect lower risk without also expecting a lower rate of return. Now, up until early 2022, interest rates had been near zero for more than a decade, and that tempted some people to look for investments that were offering better yields than what money markets and CDs were paying, a phenomenon known as chasing yield. And while interest rates have come up over the past several months, the volatility of the stock market has caused some people to continue to chase yields, in spite of the inherent risk in doing so. In the bond world, higher yields can be potentially achieved in two ways. The first is by taking incremental maturity risk, buying longer maturity bonds, which leave you vulnerable to rising interest rates as inflation heats up, thus increasing the volatility of your portfolio in a big way. Now, we've seen this happen already. Now, don't forget, when interest rates rise, the value of your bonds go down, and the longer it is until that bond matures, the more volatile its current value can be. The second method of chasing bond yield is to take credit risk, where you could lose money if the bond issuer fails to make timely payments of interest and ultimately principal. So if, for example, you're investing in corporate junk debt, you may be looking at a yield that's much higher than what you're going to see on more stable companies. That's because an investor is going to demand a higher current return than investors who own investment-grade corporate debt. Bonds are often added to the portfolio to act as a kind of hedge against the risk of owning stocks, because during stock market downturns, ideally, you want your bond investments to act as a safety net and help cushion the impact of losses in your stock portfolio. But what have we seen in 2022? Falling stock prices and falling bond prices as interest rates have risen, meaning that many people did not get any offset during this volatile market. And of course, if you own lower quality, high risk junk bonds or longer maturity bonds in an attempt to prop up your rate of return, the negative effects have been magnified. There's no shortage of headlines and websites telling you where to find high yielding investment opportunities. But before you jump in, keep in mind that chasing yield doesn't always end well. Whether it's stocks or bonds, once a point of inflection happens, it's just a matter of who's left holding the bag. This is why we have a strategy. If you want to learn more about how a bucket strategy aims to solve problems like these, just give us a call. As always, we're here to help.